In 2007, a hedge fund manager named John Paulson made $20 billion in a single year. Not for his investors, for himself personally. $20 billion in 12 months, at a time when the global financial system was beginning its most catastrophic collapse in 80 years. He did not make that money despite the collapse. He made it because of it. He had spent 2 years before the crash building a position specifically designed to profit from what he believed was coming. And when it came, he was positioned on exactly the right side of one of the worst financial disasters in modern history. Most people think investing means one thing. You buy an asset, you hope it goes up, you sell it for more than you paid. This is how ordinary investors think. It is not how hedge funds think. Hedge funds operate in a financial reality so different from ordinary investing that the two activities share almost nothing except the word money. Today on Wealth Map, we are mapping how hedge funds actually make money, the specific strategies, the specific tools, and the specific structural advantages that allow the most sophisticated investors on earth to generate returns that have almost nothing to do with whether markets go up or down. Start with the name itself, because most people have never understood what hedge actually means. The original hedge fund, launched by Alfred Winslow Jones in 1949, was built around a deceptively simple idea. If you own stocks you believe will go up, you are exposed to market risk. If the entire market falls, your stocks probably fall with it regardless of their individual quality. Jones's solution was to simultaneously hold two types of positions. Long positions, stocks he believed would outperform. Short positions, stocks he believed would underperform. The short positions acted as a hedge against broad market movements. If the market fell, his short positions would generate profits that partially offset his long position losses. The fund was hedged, hence the name. This original concept, elegant and genuinely risk-reducing, has evolved over 7 decades into something almost unrecognizably different. Modern hedge funds employ dozens of distinct strategies. Some bear almost no resemblance to the original hedging concept. What they share is this: the freedom to use any financial instrument, in any market, in any direction, with any amount of leverage, with almost no regulatory restriction on how they operate. That freedom is the foundation of everything that follows. To understand hedge fund strategy, you first need to understand short selling, because it is the tool that makes market direction independence possible. When an ordinary investor buys a stock, they are making a simple bet. This company will be worth more in the future than it is today. They profit if they are right. They lose if they are wrong. Short selling reverses this entirely. A short seller borrows shares of a company they believe is overvalued. They immediately sell those borrowed shares at the current market price. Then they wait. If the stock price falls, as they predicted, they buy the shares back at the lower price, return them to the lender, and pocket the difference. If the stock price rises, they are wrong. They must buy the shares back at a higher price than they sold them for and absorb the loss. The critical difference between a long position and a short position is this: when you buy a stock, the maximum you can lose is what you paid. The stock can only go to zero. When you short a stock, your potential loss is theoretically unlimited, because a stock can keep rising indefinitely and you must eventually buy it back. This asymmetry is why short selling requires a level of conviction, research, and risk management that ordinary long-only investing does not demand. When it is right, it is extraordinarily profitable. When it is wrong, it can be catastrophic. Now here is where hedge fund strategy becomes genuinely sophisticated. The most powerful hedge fund strategies are not about predicting market direction. They are about predicting the relationship between two assets. Consider this example. A hedge fund believes that company A is fundamentally stronger than company B, both operating in the same industry. It goes long on company and simultaneously short on company B in equal dollar amounts. If the industry as a whole rises, company A rises more. The long position profits more than the short position loses. Net gain. If the industry as a whole falls, company B falls more. The short position profits more than the long position loses. Net gain. The fund makes money, whether the industry goes up or down, as long as its prediction about the relative performance of the two companies is correct. This is called a long-short equity strategy. It is one of the most widely used approaches in the hedge fund industry, and it illustrates the core principle that separates hedge fund thinking from ordinary investment thinking. The question is never simply, will this go up? The question is, what is misprice relative to what, and how do I position myself on both sides of that mispricing simultaneously? John Paulson's trade in 2007 and 2008 was a version of this principle applied to the housing market. He did not simply predict that house prices would fall. he found a specific financial instrument, credit default, swaps on mortgage-backed securities, that allowed him to bet on the collapse of the specific segment of the mortgage market he had identified as most vulnerable. He spent 2 years building the position, paying small premiums every month to maintain it, being questioned by his own investors about why he was wasting money on what looked like an insurance policy against an event that most market participants believed was impossible. When the housing market collapsed in 2008, his credit default swaps became enormously valuable. The payout was $20 billion. The position was not a gamble. It was the logical conclusion of 18 months of research into the specific mechanics of the mortgage securitization market, research that revealed the structural flaw so fundamental that collapse was not just possible but mathematically inevitable given enough time. The difference between Paulson and the people who lost everything in the same crisis was not luck. It was the willingness to look at the same information everyone else had access to and follow the analysis to its logical conclusion, regardless of how uncomfortable that conclusion was. But there is a final layer of hedge fund advantage that goes beyond any specific strategy. Ordinary investors buy stocks. They access the market through brokers who access exchanges that have rules, delays, and cost built into every transaction. The most sophisticated quantitative hedge funds, firms like Renaissance Technologies and Sigma, operate on a completely different plane. Their algorithms execute thousands of trades per second. They co-locate their servers physically inside stock exchanges to reduce the time it takes for their orders to travel by microseconds. They extract value from price discrepancies that exist for fractions of a second and are invisible to any human observer. Renaissance Technologies, widely considered the most successful investment firm in history, has generated average annual returns of approximately 66% before fees over 30 years, using strategies so proprietary that the firm employs mathematicians and physicists rather than traditional financial analysts, and has never publicly explained how it works. The ordinary investor is not competing with this. They are simply operating in a market where this is also happening, continuously, invisibly, at a speed and scale that makes the playing field fundamentally unequal in ways that most participants never see. Hedge funds are not inherently villainous. They are not inherently beneficial. They are the logical endpoint of what happens when extraordinary freedom of instrument, freedom of direction, freedom of leverage meets extraordinary capital and extraordinary talent. Understanding how they work does not give you access to their strategies. Most of their tools are structurally unavailable to ordinary investors, but understanding the principle that sophisticated investors do not think in terms of up or down, but in terms of relationships, mispricings, and structural advantages changes how you think about every investment decision you will ever make. Because the principle is available to everyone, the tools are not. The thinking is. This is Wealth Map, where the strategies of the most sophisticated investors in the world become visible, and where we separate what you can use from what is simply useful to understand. Subscribe, because the next map reveals how one of the most powerful financial empires in history was built not on products or services, but on the systematic accumulation of something most people never think to buy.